This week, I made over $8,000 selling options. And in this video, I'm going to be sharing exactly what strike prices I chose, what stocks I chose to sell options on, and what I'm expecting going forward, as well as what I'm selecting to sell options on next week. So let's dive right into the specifics. Okay, so this video is as a result of a post that I made earlier today that got a lot of traction, and a lot of you were asking for me to make a video or basically share some more thoughts around this specifically. For those that follow the channel, you'll know that me running a wheel is something that I'm doing relatively new. I had a dividend portfolio and I saw the returns that that gave me over the last 10 months. And just in the last couple of weeks, by running a wheel, I have far surpassed the amount of money that I was making on a dividend with minimal effort. So I chose to do that instead as an ongoing strategy. And this is something that I'm learning more and more of. I have gotten assigned on a couple of positions, and a lot of positions I have gotten away with the premium collected. And so this is something that I'm learning along the way. And I'm choosing it as an experiment on about half of my portfolio. And the remainder of my portfolio, about half, is just long term stuff that I'm not holding. I'm not messing around with the cost basis, and I'm not risking getting assigned on that position. Let me fix the camera real quick. Okay, so essentially, I made this post here and I said running the wheel is honestly a cheat code. I locked in $8,500 this week. And what I did was I ran both cash secured puts and covered calls on a number of different stocks. So, and if you don't know what a cash secured put and a covered call is, then I suggest you pause this video and you do some research on that just to start with. They're very powerful, and essentially they put an upper and a lower threshold on what I think the stock could do on any given week. Now, one of the questions was, what is the time frame that I'm deciding? And the answer to that is that I am deciding to do weeklies. So I'm not selling options that are far out into the distance, a month, 2 months, 3 months. I'm doing them exclusively on 1 week duration. And the reason why is because I feel that I can cycle my money much faster. I can collect premium from a week and then I can put that premium to work immediately. And I feel that I have more optionality in terms of moving that money forward, essentially because the volatility is so much higher because the time duration is shorter. So, because essentially, if the option is expiring on Friday, that doesn't give a lot of time for you to either be right or be wrong. And because I'm selling the option, that benefits me because let's say I write a cash secured put on HIMS and then HIMS goes up 10%, the value of that underlying option that I'm writing is going to move much more. And so I had a situation this week where HIMS fell 25%, and then it fell another 7% on top of that. So over the course of 2 days, it fell over 30%. And when it hit $19, what I did was on Friday, I put a large chunk of money writing cash secured puts on HIMS at $17. I even posted the confirmation from this trade. I said, I'm writing 36 cash secured puts on HIMS at $17. Well, guess what? HIMS bounced back on Monday and actually went up. And so that cash secured put, I was able to close that out in basically one trading day for 75% profit because the time duration is so short. And then I went back the next day when HIMS had a red day and I wrote cash secured puts at $20 for HIMS. And I essentially double dipped on the same week on the same stock by collecting the majority of the premium in terms of profits. And that's partially why I got to this large amount of money over this week. And it's something that I don't suspect will continue over the long term because $8,000 a week is not realistic. More realistic is something like $2,000 or $3,000 with the amount of risk capital I have. I'm essentially expecting a rate of return around 3 to 5% a month. And right now, I got like 5% in a week in this particular week because of the volatility, because essentially HIMS was the majority of those gains and it was a stock that fell 30%. It's not going to fall 30% every single week where I can do the exact same strategy. And so I was able to capitalize on the fall because I wrote cash secured puts. And then I was able to capitalize on the bounce back because I wrote covered calls at $27. And so essentially I put these lower thresholds at $23, at $20, and at $17 for HIMS, whereby if any of them were breached, I would be forced to buy that stock at that given price. And then I put an upper threshold at $27 in the form of covered calls, whereby if HIMS were to bounce above $27, I would again be forced to let go of my existing shares at that price. Luckily, HIMS closed at about $25, and so nothing was hit, and I collected premiums on both sides of that trade. Again, that's not going to happen on any given week It just happened to be the case this week. And so I fully recognize that the results that I got this week were partially an outlier because of the volatility. And so that $8,500, how that breaks out is about 5,000 of that is entirely HIMS, and about 2,500 of that is entirely Tesla or TSLL. The rest is Clean Spark, Marathon, and QQQ. But essentially, that capital is going to be put to work next week as early as Monday morning. And Monday morning, I don't really care what happens because I have a large portion of underlying shares and I have a large portion sitting in cash. And so if we have a big green day on Monday, what I'm going to do is I'm going to write covered calls to take advantage of that volatility upwards, basically of the market running. I can write covered calls at a higher strike price. If we have a red day on Monday, then I'm going to write cash secured puts with the cash that I have that's just sitting there. I'm not doing any of this on margin, and I don't recommend doing any of this on margin because that's just, you're taking on extra risk. And then in the next day, if we have a green day, I can do the same on the covered call side. Now, I'm also not writing cash secured puts with my entire cash position because if we have like 3 red days in a row, then all of a sudden, I'm running the risk of getting assigned. The other thing is that I'm doing this only on stocks that I don't mind owning and I'm actually happy to own. Tesla is like my largest position. HIMS is a growing position. It's about 6% of my portfolio. And then Clean Spark and Marathon, I'm only doing covered calls on those because I already have the position built out. And so I'm okay to let that go at a certain price. In fact, I'm going to do Marathon $30 calls for next week. And if Marathon hits $30, well, then great. I bought it at 20, I sold it at 30. That's a 50% gain in a couple of weeks. And I got to collect premiums on top of that for the last several weeks. And so I'm perfectly happy with that as a trade. Clean Spark hits $20, then I'm perfectly happy with that as a trade as well, because I get to benefit from the premiums, but I also get to benefit from the surge in the stock price. Now, one of the other questions that I got was, how do I decide at the strike prices? Very simply put, I just look at the deltas. And so when I'm looking to open these contracts, depending on what my strategy is for those particular shares, I'm looking at different deltas. So essentially, if I have a chunk of cash in my account that I want to deploy and I want to be invested in a particular company, so let's say QQQ, or let's say HIMS, or let's say Tesla, I'll go for a higher delta. So I'll go 25 to 45 delta, which is essentially, think of it as the percentage chance that you get hit. So 25% to 45% that I get hit for stuff that I want to own. And the reason why you're going so risky is because number one, you want to own it anyways. And number two, you get a much higher premium by doing that. Now, for stuff that I don't really want to let go, I'll go 15 delta to 0.5 delta. So 5% of getting hit, 15% of getting hit. An example of this is essentially me selling covered calls on Tesla at $410 strike price. That's not going to give me a lot of premium because that's unlikely to hit at the end of the week. But if it does hit, then I get a huge upside in terms of capital gains on Tesla for that. But I don't really want to let go of those Tesla shares. And so I'll put a threshold that's far out into the distance that is unlikely to get hit. And I collect a smaller amount of premium in return. But let's say if I want to enter Tesla and I'm okay to enter it at 340, I can sell cash secured puts at 340 and collect a huge amount of premium on top of that, like $2,000 or $3,000 probably. But I'm very likely to get hit because Tesla is trading at those prices. And so essentially that's the trade-off that I make in terms of, is this a position that I want to enter at this point, or do I want to stay in cash? Is this, I mean, as TJ would say, is this a cash grab, or is this something that I want to go into? And that really decides the strike prices that I go. But generally speaking, the rule of thumb that I'm trying to go off of is stuff that I don't want to get called away, 15 to 5, stuff that I do want to get into and I just want to maximize the premium, 25 to 45. And for everything else, 25 to 15 delta is usually somewhere where I settle. So if we just go back to this tweet, Tesla and HIMS, I ran both cash secured puts and covered calls on. So I essentially put a lower floor where I'm willing to buy more, and I put an upper floor where I'm willing to sell what I already have. So for Tesla, for example, I put a covered call at 375. So if it hit 375, I would have to give up my Tesla shares. And I put a cash secured put at 305. So if it hit 305, I would be forced to buy more Tesla shares at that price. Tesla happened to close the week at 350 or so. And so I capitalized on the premium for both the top and the bottom of that range. Now, if Tesla were to close at 380, I capitalize on the bottom threshold because that doesn't get hit, but I get hit on the top threshold. So I have to give up my shares at 375 and leave $5 of gains on the table. I did the same thing for HIMS, right? I put the lower threshold on 17, 20, and 23, and the upper threshold at 27. Tesla and HIMS are two of my main holdings that I want to be owning more of, that I am okay letting go of some at certain prices to essentially capitalize on the volatility. And by having the flexibility to play both sides of that trade, I don't really care what the stock market does on Monday, because if the market opens green on Monday, then that's great. I can just write covered calls. I can put the upper threshold. And if the market opens red on Monday, then that's great because I can put the lower threshold in the form of cash secured puts. And if either of those get hit, I don't care. I don't have any stress because I want to hold that stock anyways. And I'm okay to get called away on that stock at certain prices that are far out of the money. And there's some that are more risky than others, but usually what I'm doing is I'm putting a portion of it in more risky stuff to get a higher level of premium so I can get a stronger percentage return. And I'm putting a portion of it in more safer things so that I get a lower premium, but I also get a lower likelihood of getting assigned or getting called away. And somebody asked, why am I not doing this for SOFI? SOFI is my second largest position behind Tesla. And the reason why is because the premiums for SOFI are not that lucrative. And SOFI has been on an absolute rampage over the last couple of weeks, whereby I've done this on SOFI a couple of times and I've had to roll out into the future. So essentially saying, okay, I want to buy back at a loss and I want to reopen at a gain so that I get a net credit. And because I've had my hand caught in the cookie jar a couple of times on SOFI, I don't really want to mess around with SOFI right now until it at least stabilizes. So I'm just doing it on Tesla and on HIMS, stuff that if it gets called away, I'm perfectly fine. Whereas with SOFI, I want to hold that for longer term. And again, for both Tesla and for HIMS, I have a portion that I'm holding longer term that I'm not doing anything with. I'm not touching at all. Now, the other thing that people asked the question on this post was, what am I doing for next week? Well, for next week, I'm looking at the same exact stocks. I'm looking at Tesla. I'm looking at TSLL, which I own. I'm looking at HIMS. Also, QQQ is essentially if I can't find any good deal in the market, if it's a kind of a flat day and I can't find any good deal, but I have the cash there, then I'll just write a cash secured put on QQQ on a daily basis. And that's essentially what I did here because on Tuesday or on Wednesday, I couldn't find any good deals and I had the cash there. And so essentially, I wrote a cash secured put on QQQ at about a 25 delta and I made it expire the next day. And so I collected about $100 or $200 on that day just for waiting. So if I can't find a good opportunity, I'm not going to rush the process and just go into just anything. I'm just going to go into QQ and I'm still going to get some cash flow from that capital, just essentially waiting. Now, for next week, another thing that I'm looking at, and this is more risky, but this is where I would grab more premium. So for Tesla, I would basically look to be more safe. But for grabbing more premium, I'm also looking at LMND because LMND is a company that I've been buying up. I bought it at $18. It's up like 3x since that time. It's been going up in a very parabolic move. I'm okay to essentially write some cash secured puts at LMND. I was looking at the $45 strike price. Because of the volatility in LMND, that actually makes it very lucrative from a premium perspective. But I want to do that on a small portion of my cash holdings because LMND could fall. I could get assigned those shares and then it could keep falling even further. And I don't want to be trapped in a position where I can't get rid of those shares, even though LMND is still one of those companies that I'm okay building a larger position in. Because again, the first rule of this is to not do it on any companies you do not want to be holding because you could get into the situation where you're trapped to this company and you're essentially stuck holding it. And if you're just chasing the premiums, then you could very easily be stuck in a situation where you're holding a stock that you don't want to be holding. But for myself, I want to be holding Tesla. I want to be holding HIMS. I want to be holding, a lot of these other companies that I'm doing this strategy on, but I'm not doing this on stocks that I don't want to be holding. Like Enphase, for example, is a stock that I'm looking into right now. I'm researching on the background, but I'm not really ready to pull the trigger on. So I'm not going to be running the strategy for Enphase because there is still an alternative where I do get hit and I do have to take assignment of those shares. Again, I'm not trying to rush the process because if I'm just waiting, then I'm just going to go into the QQQ and I'm going to be writing cash secured puts on the QQQ on a daily basis or every 2 days to juice some more premium out of it. And it's the QQQ. So it's essentially like the safest thing, you can do. If it falls, then, it's the entire market falling. And generally it'll go up over the long term because I can park cash there and I can get a premium on just waiting. And so in a nutshell, that's my strategy. I want to play both sides of that trade so that I can set a lower threshold in the form of cash secured puts, an upper threshold in the form of covered calls. And if I don't have any good deals, in other words, if something is not surging in a big way to the upside or the downside, I'm just going to go into the QQQ and I'm just going to wait it out until we have more volatile days in the stocks that I want to be holding over the long term, like HIMS, like Tesla, like Lemonade is something that I'm starting to build more on. Even SOFI, I'm okay to do cash secured puts on to essentially get a position that I'm wheeling and then sell covered calls against that. But the premiums are just not that good on a weekly time frame. And again, I'm just doing exclusively the weekly time frame for now because it gives me more optionality. Now, if I have to roll, so for example, for marathon, I have had to roll several times because it just gets to that point where it breaks my break even price and I want to roll it out because I think that there's still higher upside ahead and I want to be able to capitalize on that, then I'll just roll it out one more week and I'll do that for a net credit. So I guess actually get paid to renegotiate that contract one more week. Anyways, I know a lot of this is high level stuff and it might go over the heads of a lot of people that are not just options trader, but it's something that once you start to get it, it starts to click and it starts to make sense as to, hey, wait a minute, you can get paid on a weekly basis just for holding stocks that you would have otherwise held and just for making these trades where, you're doing it in a very short time frame with fundamentally great companies like HIMS, like Tesla, like SoFi, where I would be holding them anyways. And if I had to hold SoFi at $50 or at $16 and I had to buy that at that price, I would absolutely do that. If I had to buy HIMS at $23, absolutely, or Tesla at 305, absolutely would do that, right? Because I'm fundamentally bullish on these companies and I think they're going higher. And if they start to fall, well, then I have a lot of cash still on the side where I can average down and I can still do the strategy. Again, I don't think I'm going to make $8,000 next week on it. I might make 2,000 or 3,000, but it really depends. I think by having the flexibility of being able to play both sides of that trade, if we have a massive green day tomorrow, then that's good for me. If we have a massive red day tomorrow, then that's still good for me. If we have a flat day, then that's what's bad for me because the premiums that I get out of this are mainly coming from volatility because the time frame is so low. And so if we have a flat day tomorrow, then I'm probably going to enter the QQQ just to wait it out a little bit longer until we have a big volatile day. Anyways, I hope you enjoyed that. I hope it wasn't too high level, but that's essentially my strategy. And I'm just learning as I'm going along. If you want me to be talking about options on a more frequent basis, and we can even run through some options chain together, I can walk you through exactly what I'm looking at. Please let me know in the comments. And I would love to make more videos about this because it's genuinely something that is giving me more interest in the market. And I've been, rambling on for like 20 minutes now, completely off the cuff because this is exactly, what I've been looking at all week long. Thanks so much for watching. I will see you in the next one.